The Federal Reserve, America's central bank, has made a significant move that could have wide-reaching implications for the economy. They've decided to lower interest rates, a decision that has been closely watched by economists and financial analysts alike. This is a big deal because it affects borrowing costs for everyone, from individuals looking to buy homes to large corporations planning major investments. Lower rates usually mean it's cheaper to borrow money, making it more accessible for families to purchase homes, for businesses to expand, and for consumers to use credit. This can encourage spending and investment, potentially boosting the economy by creating jobs, increasing consumer spending, and driving business growth. The Fed doesn't make this decision lightly. They carefully analyze a vast array of economic data and trends before making such a move. They're closely watching inflation, which is the rate at which prices increase, to ensure it remains at a manageable level. If inflation gets too high, it can erode purchasing power, making everyday goods and services more expensive for everyone. The Fed aims to keep inflation under control while also supporting economic growth, striking a delicate balance between the two. This recent rate cut suggests the Fed might be concerned about a slowing economy, signaling potential challenges ahead. They're hoping to encourage borrowing and spending to keep things moving, stimulating economic activity and preventing a downturn. However, the impact of this decision is yet to be fully seen, and only time will tell how effective it will be in achieving the Fed's goals. The stock market is a dynamic place where companies issue shares that people can buy and sell. It's a bustling environment filled with opportunities and risks. These share prices are constantly fluctuating based on a multitude of factors, including economic data, corporate earnings, and geopolitical events. News, like the Fed's interest rate cut, can cause significant movements in the stock market. Such announcements are closely watched by investors and can lead to rapid buying or selling. When the Fed cuts interest rates, it often makes stocks more attractive to investors. Lower borrowing costs can stimulate economic growth, which is generally good for corporate earnings. That's because lower rates can lead to higher corporate profits. Companies can borrow money more cheaply to invest in growth, leading to increased revenues and potentially higher stock prices. Additionally, investors may shift money from lower-yielding bonds to stocks seeking better returns. This reallocation of assets can further drive up stock prices. This influx of money into the stock market can push prices higher, creating a positive feedback loop where rising prices attract more investors. However, the stock market doesn't always respond predictably. Market sentiment can be influenced by a variety of factors, including investor psychology and external shocks. Sometimes even positive news can cause uncertainty or fear, leading to a decline in prices. Investors may worry about overvaluation or potential future risks. It's crucial to remember that the stock market is forward-looking. Prices reflect expectations about future events and their potential impact on company profits. Investors are constantly trying to anticipate future events and their impact on company profits. This forward-looking nature makes the stock market a complex and ever-changing environment. Cryptocurrencies like Bitcoin are digital assets that have gained immense popularity in recent years. They operate independently of central banks like the Fed, which makes their relationship with traditional economic policies complex. When the Fed cuts interest rates, it can indirectly impact the cryptocurrency market. Lower interest rates can make traditional investments like bonds less attractive. This might lead some investors to seek higher returns in riskier assets like cryptocurrencies. However, cryptocurrencies are also highly volatile. Their prices can swing dramatically based on speculation, regulatory news, and even tweets from influential figures. Predicting how they'll react to the Fed's rate cut is challenging. Gold has been a store of value for centuries. Unlike currencies, its supply is limited, making it a hedge against inflation. When the Fed cuts interest rates, it can sometimes lead to a weaker dollar. This can make gold, priced in dollars, more expensive to buy. Additionally, in times of economic uncertainty, investors often flock to safe haven assets like gold. If they perceive the Fed's rate cut as a sign of weakness in the economy, they might increase their gold holdings. However, gold prices are also influenced by other factors, like industrial demand and global supply and demand dynamics. It's not a guaranteed winner when the Fed cuts rates. Section 5. Bitcoin in 2025, a high-stakes gamble. Predicting Bitcoin's price in 2025 is a highly speculative endeavor. Bitcoin is notorious for its volatility, experiencing dramatic price swings both upwards and downwards. Factors that could influence Bitcoin's price in 2025 include regulation. Governments worldwide are grappling with how to regulate cryptocurrencies. Strict regulations could hinder Bitcoin's growth. Adoption is another factor. Wider adoption by merchants and institutions could increase demand and price. Technological advancements also play a role. New blockchain technologies or competitors could emerge, impacting Bitcoin's dominance. Predicting Bitcoin's future is more akin to reading tea leaves than relying on traditional economic indicators. Section 6. The Fed's next move. Will rates fall further? The Fed's decision on future interest rate cuts will depend on several factors. They'll be closely monitoring economic data, including inflation. If inflation remains under control, it gives the Fed more room to maneuver and potentially cut rates further. Economic growth is also crucial. If the economy shows signs of weakness, the Fed might cut rates to stimulate growth. Global economic conditions are important too. A global slowdown could also influence the Fed's decision-making. The Fed will likely take a data-dependent approach, meaning their actions will be guided by the most up-to-date information available. This makes predicting their next move a constant source of speculation for economists and investors alike. Section 7. Winners and losers navigating the new landscape. The Fed's rate cut creates both winners and losers in the economy. Potential winners include borrowers, as lower interest rates translate to cheaper loans, making it more affordable for individuals and businesses to borrow money. Stock market investors might also benefit, as lower rates can boost stock prices, potentially benefiting investors. On the flip side, potential losers include savers, since lower interest rates mean lower returns on savings accounts and certificates of deposit. Individuals on fixed incomes might see their purchasing power erode if inflation rises. It's important to remember that the overall impact of the Fed's decision is complex and multifaceted. What might benefit one group could negatively affect another. Section 8. The housing puzzle. Will lower rates unlock the door? The housing market is always a key area of focus when the Fed adjusts interest rates. These adjustments can have a ripple effect across the entire economy, influencing not just home buyers, but also investors and financial institutions. Lower rates usually translate to lower mortgage rates, making it more affordable for people to buy homes. This can lead to increased demand in the housing market, as more people find it financially feasible to purchase property. However, the relationship between interest rates and the housing market isn't always straightforward. While lower rates can boost demand, they don't automatically solve all the challenges facing potential home buyers. Other factors at play include housing supply, as a shortage of available homes can drive up prices even with lower interest rates. This can create a competitive market where buyers might still struggle to find affordable options. Job market conditions are also crucial, since people need stable jobs and income to qualify for mortgages and afford housing payments. A strong job market can support a healthy housing market, while high unemployment can have the opposite effect. Additionally, consumer confidence plays a role. If people are uncertain about the economy, they might delay major purchases like homes. Economic uncertainty can lead to hesitation, even if mortgage rates are favorable. The impact of the Fed's rate cut on the housing market will depend on the interplay of all these factors. It's a complex puzzle where interest rates are just one piece, and the overall picture is influenced by a variety of economic conditions and consumer behaviors. Section 9. The Fed's balancing act: inflation versus growth. The Federal Reserve faces a delicate balancing act, controlling inflation while promoting economic growth. Inflation erodes purchasing power and can destabilize the economy. However, overly aggressive attempts to curb inflation can stifle economic growth and lead to recession. The Fed walks a tightrope. They use interest rates as a tool to influence borrowing costs, spending, and investment. Finding the right balance is crucial for a healthy and stable economy. Section 10. A long road ahead. Uncertainties remain. The Fed's decision to cut interest rates is just one event in a complex and ever-changing economic landscape. Numerous factors will shape the coming months and years, including geopolitical events like trade tensions, political instability, or global conflicts, which can significantly impact the economy. Technological disruption is another factor, as rapid advancements in technology can create new opportunities but also lead to job displacement and economic uncertainty. Climate change also plays a role. The increasing frequency and severity of extreme weather events can disrupt supply chains, impact agriculture, and require costly adaptations. Navigating these challenges will require careful planning, adaptability, and a willingness to embrace change. The only certainty is that the future will continue to surprise us.